So you've decided to start your business and you still struggle with the question of whether you should incorporate or operate as a sole proprietorship. You find it difficult to find a comprehensive information online. Some information seems misleading, some information seems incomplete, and that is true. And today's presentation is specifically for this purpose. I will try to cover all the considerations and all the contemplations that you should look at when making a decision whether to incorporate or not. Hi and welcome to Business in Canada Do It Right, me Eugene Jakubov. Let's start today's presentation. So when you look online and when you search or when you even review my previous presentations, you will see that tax planning will be one of the major considerations that people speak about. Many of the accountants will talk about this consideration as the only one to incorporate or not to incorporate, but there are multiple others that sometimes become significantly more important than tax planning, specifically shielding of liabilities. Essentially, when you operate or you plan to operate high risk type of operations, and I'll talk about it and I'll show you, demonstrate it in a moment. The incorporation is the only tool to manage. Working with partners, again, even if you don't reach the personally tax level that justifies incorporation, but you want to work with partners, you want to split the business among the partners, especially if those partners work on different levels. I'll show you in a moment. Incorporation is the only feasible tool that allows you to do so. Plan for the future growth and expansion, create the foundation. Again, in my opinion, if you've seen my previous videos, sole proprietorship is not fit for the growing, expanding businesses. It will only justify operating very small kind of basement-based business. There are other considerations that might justify incorporation even without any of the previous. One of the major one is the capital gain exemptions. Essentially, if you decide to sell your business and generate profit from it, a lot of it will be shielded if you use a corporation properly. Right now, the capital gain exemption total amount in Canada is about $900,000. So think about it. You will get it tax-free almost if you do it right, if you comply with the capital gain exemption rules. And so these are the main considerations. Now let's go through each of them, and I'll try to provide a little bit more detailed explanation to each of these explanations and considerations. So first, as I already said, would be tax planning. You can find a lot of information. People speak about corporation being a separate taxable entity, which means you will file taxes separately for the corporation. In most of the cases, a Canadian controlled private corporation, which means corporation owned by 51+% by Canadian tax resident, could be PR citizen or just tax resident, you will be subject to significantly lower 12% income tax for the first $500,000 of profits. Now, if you are familiar, and I hope you are, with your personal income tax, you will realize that very fast, personally, you reach to 30, 40, and sometimes 52% of personal income tax, and you get to those points significantly faster than $500,000. Usually within $60,000, $70,000 of annual personal profits, you will be paying more taxes than the corporation. You report taxes separately, not only as two separate individuals, but also you can split the timing of reporting. Essentially, corporation allows you to define your fiscal year, which is not necessarily your calendar year. Personally, it is only calendar. And that will allow you, let's say, to take money out of the corporation for a short period of time of almost up to 1 year without paying taxes, as long as you return the money or you do it right. Consult with your accountant who understands how the system works. Corporation will also help you to keep profits inside the corporation under that lower tax rates until you actually need to pull them out or you can justify pulling them out. I'll talk about it in a moment. So here's the summary for tax planning consideration. Incorporate if you will make more than $60,000 of profits. Now, profit here means not just business profit, but also less of your basic personal expenses, mortgage, car, children's education, because all those you will need to take out anyway as a personal income. So if you look at the bottom line of what is left, which is corporate profits and less your personal expenses. If it's still more than $60,000, $70,000, then in corporate, you'll just will pay significantly lower taxes. You have other sources of income. So let's say you start a business while still being employed somewhere. Keep in mind that each dollar that you will generate as a profit from your business will be added on top of your salary if you do it as a sole proprietorship. If you do it as a corporation, it will be held aside within the corporation as a separate legal entity, and you will be declaring taxes there at 12%. While if, let's say, you have a current income of $80,000 per year, each additional dollar will be taxed at about 35 to 45%, depending on the total income that you will be reporting personally. Again, if you want to recognize that income later. So in many cases, you start your business as an employee somewhere, you work and you develop your business over time, and then you plan in the future to retire or resign from your employment and concentrate on your business. At that time, you will be able to pull money out because you will not have that personal salary that will jump you into the higher tax brackets, and you will be able to plan more efficiently how you take money out of the corporation. Second major consideration is the shielding of liabilities. Again, very important, in many cases more important than tax planning, and I'll show you why. So first of all, you have to incorporate when you plan to provide and operate high-risk operations, essentially construction, working at heights, working with heavy industry, chemicals, high heat operations, because if something happens there to your employees, to your workers, to third parties involved in the business operations, you will be personally liable if you're sole proprietor. If you're a corporation, the liability in most of the cases will stay within the corporate legal entity, essentially shielding your personal assets. Now think about a serious injury that can be caused as a result of your business operations that the insurance might not cover, and then your personal assets will be used to cover the losses and the legal costs and the outcomes of the legal processes. And that can end up to be significantly more than just tax planning from the previous slide. When you sell or offer high-risk services, you sell food, you sell medical devices, you sell drugs, childcare, anything that can happen within high-risk operations. As I always tell to my clients, think about the worst-case scenario. Where do you want to be, and how bad it can happen, and then decide if you want to shield your private assets and your personal finances from those future claims or not. Now, when you want to employ individuals, the more you employ individuals, the higher the responsibilities and liabilities will be. They will be essentially accumulate, and you will want to protect yourself and your personal assets from the business operations. Working with partners, again, extremely important consideration, because it is impossible to split sole proprietorship between partners. And there are an option of different types of partnerships, but in my opinion, they're significantly more cumbersome and complicated rather than just incorporate, issue shares to different partners on different levels. So in my opinion, corporation is the only tool. Corporation allows you to distribute the ownership, the control, and the participation in the profits of the corporation among partners, but it also allows you to separate. So essentially, you can have partners that participate in control, equity, and dividends. You can have other partners that participate only in equity and dividends. Those who are investors into your business, they usually do not need control. They don't want to participate in your business operations or meeting of the board of directors. The only way to do it is the corporation. The sole proprietorship will not provide you with these tools under any circumstances. So if you plan to work with partners, incorporate. If you already have partners, you foresee in the future working with partners. So let's say you start your business, but you do expect, or you want, or you dream about your business becoming bigger, more advanced and diverse than what it is now. Incorporate now. Keep the corporate entity, let it grow, let it accumulate the years on the market, instead of incorporating something new just when you hit the point of discussing that with the partners. Again, as I said, you want to offer separate privileges and rights to your partners on different levels. The only way to do it is the corporation. And another reason is if you want to use corporate shares for the family planning. So the family taxation, separating or splitting the income between different family members who participate in the business, who don't participate in the business. It's a little bit more complex estate planning that will need additional advice, not from me, from someone more experienced, but this is the only tool to do it through the corporation. There are some additional considerations that I think might justify incorporating, even if you find those insufficient. So when you plan to work with larger clients, you have to keep in mind that corporation is usually perceived as a larger, more serious, more responsible type of operations, especially overseas. Many people look at sole proprietorship as something lower level of operation, which is not true, but the perception is there. And if you want to enjoy the benefits of this perception, then incorporate. Now, when you use expensive assets for your business or you have personal expensive assets, in both situations, incorporation will be a justified solution. Now, of course, the more you have expensive business assets inside your business, I will also suggest considering creating a holding structure with two corporations, one holding the assets, and you can watch the video about that in the link below. But corporation definitely will help you to protect your personal assets and to manage proper use of expensive assets for your business operations. You plan to sell business in the future, not even today or tomorrow. You should also keep in mind that the capital gain exemption requires you to work a certain period of time, at least 2 years for the corporation. So plan in advance, incorporate. If you even think about, okay, I'll start it now, but maybe I'll sell it 5 years down the road, incorporate. This will definitely facilitate better the sale transaction in the future. If you foresee future growth, expansion, hiring employees, working with partners, investors, all these additional considerations, 100% will justify incorporation, and 100% the sole proprietorship will not provide proper tools for management of these relationships. And that essentially completes my today's presentation. Thank you for being with me, Eugene from CBS, Canadian Business and Enterprise Services. Here's the contact information if you need my assistance with incorporating your business or further understanding of the liabilities, responsibilities of U.S. business owners. There's also a link for my new project, businessdocs.ca. I will put the link in the description below. You can download multiple documents there. I also will add more information and more explanation to each of the documents in the website. Many documents are offered for free, others for pay, but at the prices significantly lower than the ordering these documents from lawyers. Again, thank you for being with me today. Good luck with your businesses, and I'll see you soon with new presentations. Bye-bye.